Next in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry Lutz. It is Monday, January 19th. So much going on. Currency markets in upheaval. Fortunately, in the U.S. today, it's a holiday. But for John Rubino and I, well, just like the markets, we never sleep. John, welcome back.
Hey, Kerry.
Hey.
Good to talk to you again.
Yeah. So besides Bitcoin, which isn't really a currency at all, now we're discovering all of a sudden the euro still in shock. And more shocks on the way, it appears, huh?
Well, Bitcoin tanked in the last couple of months, too, which kind of implies that it is a currency, just like these other incredibly volatile pieces of make-believe paper. But yeah, this was an eventful week. And I guess the biggest story is obviously Switzerland. They, on Thursday, announced that they were giving up on their peg to the euro. You know, they had been suffering because the currency was too strong, so they decided to just peg it to the euro, which means they were going to accept eurozone levels of deflation or inflation going forward. And that seemed like a bizarre thing for Switzerland, which is historically a bastion of sound money to do. And it turned out not to work for them because basically they had to buy huge amounts of euros in order to keep their currency at the 1.2 Swiss francs to the euro peg. And that meant the Swiss National Bank's balance sheet was exploding. They were buying billions and billions of dollars of euros, just as the Eurozone was getting ready to embark on another big quantitative easing program designed to make the euro less valuable. So that means the Swiss National Bank was going to lose huge amounts of money on its euro investment and was putting itself at greater and greater risk the more it continued to buy back euros. So finally, they just gave up. And so the Swiss franc shot through the roof and the euro versus the Swiss franc tanked. And the Swiss National Bank ended up taking a huge loss on its euro positions anyhow. It called into question the credibility of central bank pronouncements going forward, because if we can't trust the Swiss National Bank, can we trust anybody? Which, you and I for years have been saying you can't trust any central bank. Obviously, they don't know what they're doing. They're just kind of trying to get through the next election cycle, trying to get reappointed when their terms are up. They don't have any actual plan for returning the global economy to sustainable growth, because there's no way to do that with all the debt that they've allowed to be taken on in the past. You have to wipe out the debt before you can set the stage for a sustainable, organically growing economy again. And to the extent that they try to prevent debts from being wiped out, they delay the inevitable reckoning. So they haven't fixed anything, and they must know that too. So they're just winging it. And anyhow, one of the interesting things about the Swiss National Bank announcement is that it happened on a Thursday while the markets were still open. Normally, big announcements like this take place over the weekend to give the markets a chance to kind of digest it and to minimize the amount of open positions that are affected by the announcement, because there are a lot of, especially in the foreign exchange markets, a lot of traders who close out their positions on Friday. They don't go through the weekend with open positions because too much can happen on weekends to invalidate their bets. So had they made that announcement on the weekend, there would have been a lot less money at risk and a lot fewer casualties from this. But they did it on a Thursday when there were huge open positions all over the world. And so, some hedge funds got wiped out, and a lot of other players in the foreign exchange market are suffering right now. And, among the victims are people who took out Swiss franc mortgages in other countries. In Poland, apparently, a lot of people bought houses by borrowing Swiss francs. And so all of a sudden, their mortgages just got 20 or 30% more expensive. And a lot of French municipalities have Swiss franc debt, which apparently they thought was a good deal because the Swiss franc was pegged to the euro, and it was so it was the same thing as borrowing euros but at lower interest rates. Well, all of a sudden their debts are now 20 or 30% more onerous than they were, and so these guys are all clamoring for bailouts, and the hedge funds that were wiped out by this are just disappearing, and the foreign exchange brokers that couldn't keep up with the speed of the movement in these currencies found themselves on the wrong side of a lot of trades that cost them huge amounts of money, and they're going broke. So, there are reverberations around the world right now from the Swiss National Bank's decision. And I got to say that's just the beginning, because who else can maintain currency pegs with the big currencies when they're doing such weird stuff now? We got the dollar shooting through the roof. So anybody who's pegged to the dollar is seeing their own currencies go up in value to the point where it's debilitating. Anybody who's pegged to the euro is looking at their currencies being devalued by 15 or 20 or 30 more percent, if that's the goal of the ECB, which it seems to be. And so this kind of instability is a problem for everybody, not to mention the derivatives that are out there that are premised on relative stability. If you're taking a derivatives position in interest rates or in foreign currencies, you don't want wild swings. You want the market to kind of stay where it is, so your derivatives make the money that you thought they were going to make when you set it up, and your counterparty doesn't get wiped out by some wild move and then can't pay off. So what's happening in the derivatives market right now is that everybody is petrified. They don't know what's coming next. They have no way to calculate their gains and losses because they have no idea whether their counterparty is going to be able to make good on that side of the deal. So the derivatives markets are at extreme risk right now. And since the volatility doesn't seem to be ending, we're going to see a lot of derivatives blow up in the next few months. And that's already baked into the cake. The question is how many more will blow up based on the volatility that's coming in the next few months. You got the Eurozone trying to figure out how to do its quantitative easing, get through the German courts, et cetera, et cetera. And then once they start, that'll have a profound impact on the global economy, because the Eurozone is very big, and they're talking, more than $500 billion of QE. That's not big enough to really save them, because we've already seen the U.S. and Japan try bigger debt monetization programs, and it didn't work at all for Japan. And the U.S., it was kind of it was kind of a false dawn for us, it looks like, because we've had relatively good growth over the last couple of years, but that was really just because the dollar was weak for a while, because our QE program started first, so we got the first mover advantage in currency devaluation. And now the dollar's going back up because these other currencies are beginning to be devalued by their governments and central banks. And so we're going to suffer in the years ahead from having a too strong currency. So, there's no real solution to any of this, because we at the root of the problem is our inability and unwillingness to let the debt that was taken on, that shouldn't have been taken on, be wiped out. So until that's fixed, we're just going to have chaos.
Yeah, and chaos, chaos is what it's all about. And you just have to look at what's going on with the franc and the dollar to know that this can't have a happy ending, and the euro, too, for that matter. I mean, the euro was down to 115 and change. Now it's up a little bit to 116. One of my Elliott Wave theorist guests, Avi, I can't remember his last name, said he saw the year finishing out with the euro at 110, and that was about a month and a half ago, and it's like pretty dramatic call. But now, be surprised if it finishes as high as 110 at the rate that it's going. Especially, you've got Greece making noises about withdrawing, and man, if Greece withdraws, it's hard to envision the euro staying together in its present form.
Well, yeah. With the euro, there are really just two choices going forward right now. You either let Greece leave, which will cause chaos in the banking sector, because the Greece will go back to the drachma, its old currency, devalue it dramatically, and then all the euro-denominated debt that people own that Greece has issued in the past few years becomes drachma debt. And it's worth, 2/3 as much as it was to begin with. So all the big banks in Europe will have to take massive losses. Or you bail Greece out big time. You write off a bunch of their debt and put them on a sustainable financial footing. Excuse me. But then Italy and several other peripheral Eurozone countries are going to want the same deal because they're in kind of the same boat. In Italy, for instance, its government debt is soaring. It goes up year after year after year. It was already debilitating a decade ago, and now it's, 135% of GDP and rising. So if you bail out Greece, you kind of have to bail out Italy, or else they become the next Greece where they're threatening to leave. And Italy's so much bigger that their problems are vastly more threatening than anything Greece can do to the Eurozone. So this isn't over. And whichever thing they decide, when Greece has its elections and they elect an anti-austerity government, which it looks like they're going to do, then it's decision time. But there's no good decision. Either thing that the Eurozone does is going to lead to more and frequently unintended problems that they'll still have to deal with later in the year. So, it's a mess wherever you look. And there are so many moving parts. As we talked about before we went on the air, it's really hard to make any kind of specific predictions because there are so many secondary effects and tertiary effects that kind of intertwine among all these different countries and currencies, that all you can say is going to be highly volatile. You can't say this is specifically going to happen, or at least I wouldn't venture to say it. It just looks like things are going to be crazy and that we're going to have more surprises like the Swiss National Bank thing going forward. They won't be telegraphed. They'll just happen as the Swiss thing did. And so we'll just wake up in the morning and find some new crazy thing happened, every couple of weeks going forward until the system just flat out falls apart, and then we'll resolve it. But that's a ways away. And we have to go through the period of increasing chaos to get there.
Yeah. Well, hey, and what's it all going to mean for gold and silver, precious metals? What you should be doing? Where is safety? What is safety in this new environment? Well, that's what we'll be talking about next on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
And you're listening to the Financial Survival Network. We're talking with John Rubino of dollarcollapse.com and author of The Money Bubble. And John, so look, we had a huge spike in gold and silver last week. I mean, gold's down a little bit today, but you kind of expect it to get manipulated down on a holiday in the U.S. It's down roughly, it's down $4 now. It's in the high 1200s. It's at 1277 now. Silver broke through $17. It's at 1773 right now. Everything about what's happened to precious metals in the past 3 years has been counterintuitive. Maybe we're going back to a time where things make sense again in the precious metals markets. Do you think that's possible?
You would have expected gold and silver to be prime beneficiaries of the aggressive devaluation of a major currency like the euro. And, in other currencies, gold is way up in the past year. Gold was the second best performing currency, if you think of it as money. And it only went down against the dollar in 2014. So the bull market has really resumed for precious metals. And we don't see it yet because we're dealing in dollars and we see gold is down year over year, marginally. But you would think intuitively that in a time of chaos where you can't trust central banks, you can't trust governments, the big currencies, or at least some of the big currencies, are actively being devalued by their governments. You would think a lot of money would be flowing into precious metals because that's traditionally where you go to hide when stuff like this is happening. And the fact that it's not is interesting. And, it's not completely clear why. On the one hand, you've got deflation out there as the reason that these governments are actively trying to depreciate their currencies. So deflation is typically not the best thing for what a lot of people see as an inflation hedge. So if you expect your currency to get more valuable because you see prices going down, then it's not as compelling to buy something to protect you against the opposite move, even though your governments are trying to engineer those moves. And on the other hand, it's fairly clear that the world central banks have been, among all the things they've been manipulating, gold is one of them. They've been intervening at odd times with central bank gold and bullion bank futures contracts to push down the price of gold and to make it painful to speculate, especially with leverage on an increasing price of gold. And so it's worked, but it can't work forever just because the imbalances are building up to such an insane extent. So it's completely possible that we have another huge deflationary scare in the year ahead that is sort of like 2008, when every single commodity, including gold and silver, get whacked. And but of course, that just sets the stage for aggressive debt monetization on a scale we've never seen before. If 2008, 2009, 2010 QE programs are perceived not to have worked, and that's the only tool that the world central banks have, they'll just go bigger. It's all make-believe. They'll just type in an extra zero. Instead of $2 trillion, they'll type in $20 trillion and hit send and see how that works. Yeah. So at some point, these unlimited printing presses will overwhelm the huge but finite amounts of bad debt that exists in the world. And so we'll get the major currencies of the world losing credibility and really falling off the table. But there's no way to know when. There are just too many moving parts here. So, investors should totally own some precious metals as insurance against it happening sooner rather than later. And they'll be glad they did. But in the meantime, there is no way to know what happens in the next year or two because, you got these huge titanic forces out there. You've got all this bad paper, which is profoundly deflationary, and you've got these unlimited central banks just cranking out new currency at rates never before seen. So they'll resolve. And they'll resolve probably in favor of the unlimited printing press, but we can't know when.
Mm-hmm. Yeah, I think you're right. It's the timing that's impossible to know, but the outcome is pretty preordained and fairly obvious, isn't it?
Yeah. The numbers are pretty obvious. And the fact that people are losing faith in one major piece of the financial market after another. You got the euro being the latest casualty in the currency war, but it's kind of going around the table. If the euro manages somehow, some way to stabilize, then somebody else will be a problem. And it's going to go like that until the system just completely breaks down. And you're seeing a lot of models out there now that predict sooner rather than later. And that's really beyond my expertise to say anything about the timing. But, a lot of smart guys are starting to say, okay, this is the year. And I wouldn't argue with that. 2005 felt like a year to me. And certainly 2008, 2009 felt like the end of this run. So the next one could easily be the big one. And another big financial crisis does feel like it's coming because we're seeing increasing amplitude of market moves now. Volatility is really starting to increase where a 200-point move on the Dow is nothing anymore. And you just saw the Chinese stock market drop by, 6 or 7% last night?
Yeah.
Yeah, just a huge move. And so stuff like that is starting to seem normal, whereas in quote unquote normal times, prior to the advent of QE, big market moves were notable. That was sort of front page news. And now it's just, another 200 points on the Dow. Was it up or down? It was down today, but yesterday it was up. Yeah.
Who cares?
So, yeah. Yeah, and it's just not news anymore. And that's a sign that the system is starting to break down. And so actually that's what happened in 2006, 2007. Look at the stock market, a chart from that time, and you see the spikes, the peaks and valleys really start to expand. And so we're seeing the same thing now, which implies that we're heading for some kind of a resolution of this latest bout of incredibly bad financial management. And how it plays out is impossible to say, but volatility is pretty much guaranteed in the year ahead.
Yeah. And, you're seeing, I don't know if you noticed the bank earnings in the U.S. Last week, but they were almost all pretty well uniformly down. And, they really took it in the chin. And you got to figure they've been manipulated in their earnings for years. If they can't even manipulate them up anymore, things are really bad there. And they're going to get worse.
What happened to the days when Goldman Sachs made money on its trading desk every single day, no matter what the market did, So they are apparently not able to manipulate these markets the way they used to be. Mm-hmm. And it could just be that they're being watched more closely now. The regulators are starting to demand that they still aren't putting any of these guys in jail for committing crimes, but they're demanding bigger and bigger paybacks, kickbacks. So the cost of doing business for financial crime is rising and the margins are narrowing. And so it could be that these guys are just deciding that they're not going to commit those particular kinds of crimes that used to make money for them on their prop trading desks. And so they're actually having their traders try to trade rather than manipulate these markets. And it's turning out to be harder than they thought, where somebody has to lose if somebody else wins. And we're finding out that a lot of these big banks are losing. And that's another thing about extreme volatility, is that it's not good for these prop trading desks either, because it catches them off guard. You can be right, and then the Swiss National Bank does what it did, and then you're wrong, and it wipes out your past year's earnings.
Yeah,
and there's no way.
5 years put you out of business.
Yeah. There's no way to know ahead of time when something like this is coming, because they're not announcing it anymore. The Swiss National Bank didn't even tell the IMF.
Right.
Because what normally happens is a central bank will get ready to do something fairly serious, but they'll tell all the cronies first, so those guys can take their positions and make a huge amount of money off of it, right? That's one of the ways the big banks make their money, is front-running government decision-making.
Yeah.
And so if governments aren't going to tell the big banks and even the IMF what they're going to do ahead of time now, if they're going to surprise them, then all of a sudden trading gets really hard. You can't just make a guaranteed profit on the next Fed announcement.
Yeah. How are you going to make money off of crony capitalism if the cronies don't get tipped off, John,
Mm-hmm. Yep. Yeah.
What's a crony capitalist to do?
Actually try to make money the honest way. And that's really hard. That's really hard. Yeah.
You can't make money the old fashioned way. What's the world coming to?
Yeah. So
that was remarkable. I'm glad you brought that up, that they didn't tip off the IMF, because if they had, then everybody on the street and in the city would have known about it, been prepared, would have cashed in. And the move probably would have been far worse than it actually was.
It would have been a completely different thing. Goldman Sachs would have come out with a short the euro, buy Swiss francs trade recommendation a week ahead of time.
Yeah.
And it would have looked like a genius. It would have made a fortune. And because that's how it normally works. These guys come out with recommendations for their favorite clients ahead of time. And then some big announcement moves the market in a certain way. And they look like geniuses, but really what they are is trading on inside information. And so this time it didn't happen. This time they didn't get to do it. And so they're finding out that the world is a much harsher place when you're just a trader instead of a crony, like you said.
Isn't that great? So you gotta enjoy seeing that, where they actually get burned by the market that they've been manipulating for, forever now. And
if it results in some big bankruptcies, that is such a good thing, because capitalism requires failure. for it to function. You got to have object lessons out there. You got to have somebody who just did something too aggressive and paid a price for it. So everybody else can look at that and say, oh, okay, let me be a little more prudent. Yeah. And we haven't had that for 15 or 20 years now. We've had the Greenspan put, where big banks can be as aggressive as they want to, take any kind of crazy risk, knowing that the government will bail them out if they get into trouble. And also knowing that if their risks pay off, they make billions and billions of dollars, which translate into tens or hundreds of millions of dollars of bonuses at the end of the year. And so it's a no-lose game for them.
Yeah, no bonuses, no bonuses for you. And on that note, we will be talking to you next week. Check out John's work at dollarcollapse.com. Go over to financialsurvivalnetwork.com. Make sure you sign up for our newsletter. Check out the latest word, because it's not what you're going to be hearing from the PC mainstream financial media, which couldn't see this coming, but Martin Armstrong saw it coming long ago. John, we'll talk to you next week. Be well.
See you, Kerry. Take care.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.